A $2,100 yearly hit from a July rate hike? The Federal Reserve is considering a July rate hike, and it's crucial to understand how this affects your mortgage, credit card debt, and savings. We'll explore what's driving this decision and what you can do to prepare. A July rate hike could increase your mortgage payments by $300 to $400 per month, depending on your loan amount and interest rate. For example, a $300,000 mortgage with a 4% interest rate could see payments rise from $1,432 to $1,733. And if you have credit card debt, you could see your interest rates jump from 18% to 22%, adding $200 to $300 to your yearly payments. But what's driving this rate hike? The Federal Reserve is trying to combat inflation, which has risen from 2% to 4% in the past year, with oil prices increasing by 20% in the same period. This rate hike could also affect your savings, as higher interest rates might lead to lower stock prices. For instance, the S&P 500 has historically dropped by 5 to 10% in the 6 months following a rate hike. Additionally, consider the case of John, who has a $200,000 mortgage with a 3.5% interest rate. If the rate hike occurs, his monthly payments could increase by $150, resulting in an extra $1,800 per year. Furthermore, back in 2015, the Federal Reserve raised interest rates, and the stock market experienced a brief downturn, but then recovered. So, what can you do to prepare? We'll discuss that in the next section. But the part that surprised me most is how this rate hike affects your 401k. For example, a $100,000 401k could lose $10,000 in value, and what you can do to protect it, which we'll dive into next, including a specific strategy that can help you come out on top. You'll also learn how to avoid a common mistake that could cost you thousands in the long run. A July rate hike could lead to a 5 to 10% drop in the stock market, which might impact your 401k. For example, if you have $100,000 in your 401k and the market drops by 7%, you could lose $7,000. However, this rate hike could also lead to higher interest rates on savings accounts, which might benefit your emergency fund. Let's consider a historical comparison. In 2018, the Federal Reserve raised interest rates, and the stock market dropped by 4% in the following quarter. But the interest rates on savings accounts increased, allowing savers to earn more interest. And if you're planning to buy a house, this rate hike might actually help you in the long run, as higher interest rates can lead to lower housing prices. For instance, in 2006, the Federal Reserve raised interest rates, and the housing market began to decline, making it easier for buyers to purchase homes. Additionally, a second-order effect to consider is how the rate hike might impact the value of the US dollar, which could affect international investments and travel plans. So, what's the best course of action for your 401k and savings? We'll explore that in the next section, including a strategy that could help you earn an extra $1,000 per year. Now, let's talk about how to protect your finances from this rate hike. The strategies might surprise you, including a common misconception about refinancing your mortgage that could cost you thousands, which we'll debunk next and provide a clear plan to protect your wallet. You'll also learn how to take advantage of the rate hike to earn more interest on your savings. To protect your finances from the July rate hike, consider paying off high-interest debt, such as credit card balances, and building an emergency fund to cover 3 to 6 months of living expenses. You could also explore refinancing your mortgage to a lower interest rate or switching to a fixed-rate loan. Additionally, you might want to diversify your investments to minimize the impact of a potential stock market drop. For example, you could allocate 60% of your portfolio to stocks and 40% to bonds. But what about the potential benefits of a rate hike? Higher interest rates could lead to increased interest earnings on your savings accounts, which might help you reach your financial goals faster. And if you're a saver, you could take advantage of higher interest rates on certificates of deposit, CDs, or high-yield savings accounts. For instance, a $10,000 CD with a 2% interest rate could earn $200 in interest per year, but with a rate hike, that same CD could earn $300 in interest per year. Furthermore, back in 2004, the Federal Reserve raised interest rates, and the economy experienced a period of sustained growth. So, what's the best strategy for your situation? We'll discuss that in the final section, including a step-by-step plan to help you navigate the rate hike. Some experts argue that the July rate hike might not have a significant impact on the economy, as the labor market is still strong and consumer spending is high. In fact, the unemployment rate has dropped to 3.6%, and average hourly earnings have increased by 4.3% in the past year. Additionally, the housing market is still growing, with existing home sales rising by 2.5% in the past quarter. Furthermore, back in 2008, the Federal Reserve implemented a series of rate hikes, and while the economy did slow down, it ultimately led to a period of sustained growth. For example, the S&P 500 index increased by 50% in the 2 years following the rate hikes. So, what does this mean for your finances? If the rate hike doesn't have a major impact, you might not need to make significant changes to your financial plan. But it's still essential to be prepared and have a strategy in place. A second-order effect to consider is how the rate hike might impact the value of the US dollar, which could affect international investments and travel plans. Now, let's summarize the key takeaways and provide an actionable next step. In conclusion, a July rate hike could cost you $2,100 a year, but by understanding the potential impact and taking proactive steps, you can protect your finances. Consider paying off high-interest debt, building an emergency fund, and diversifying your investments. To take it a step further, schedule a meeting with a financial advisor to review your portfolio and create a personalized plan. Additionally, take a closer look at your budget and identify areas where you can cut back on unnecessary expenses to free up more money for savings and debt repayment. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about the July rate hike, hit subscribe. I break down one of these every week, and as a bonus, download our free guide to navigating rate hikes at the link in the description below.